Today, the 8th rate rise in a row. What next? Hello again, it's Martin North from Digital Finance Analytics, world latest post covering finance and broad news with a distinctively Australian flavour. Today, I'm joined by Peter Marshall from Mozo. Hi, Peter.
Hi, Martin. Great to see you again.
Well, thanks very much. And of course, we're doing our monthly review of the Reserve Bank. They lifted, as expected, 25 basis points. But they did sort of indicate that there might be more ahead. So we should not get too optimistic that the peak is reached yet.
Yeah, perhaps the RBA is being a bit cautious at the moment, having been burnt by their previous claims that rates wouldn't rise until 2024. So, yeah, maybe they're just trying not to get people's hopes up too much at the moment.
And of course, CBA has now revised their terminal rate up because they were the one at the bottom of the rank, and now they're saying, well, it'll probably be a bit higher. But I guess we should reflect on what is the implication for households who have mortgages and perhaps were thinking that rates were going to stay low, which is what, of course, the Reserve Bank said previously, because it's beginning to pile up now, a 3% hike from 0.1 to 3.1. It's a pretty significant change, isn't it?
Yeah, it's huge. The impact on household budgets is massive, particularly if you do have a larger mortgage. The amount of money that people are needing to find on top of what they were paying prior to these hikes is quite meaningful. It's easily $1,000. So, yeah, it's got to be having a huge impact on people's budgets by now.
And of course, we've got the other problem, which is that the fixed rate reset, which is due, well, any time from this point on, because of course there was a significant surge in fixed rates 2 or 3 years ago. I think the suggestion is that middle of next year is probably going to be a significant peak.
Yeah, over the next 12 months, we'll have a lot of people starting to roll off those fixed rates, but that will extend for some time. Those rates could have been anywhere from sort of 1 to 3 years typically. So the people on a 3-year rate won't be rolling off just yet. It's those shorter term people that will be starting to feel the pain from switching from a fixed rate to something else.
So what are you seeing on the portal? Are there lots of people seeking out better rates and trying to switch to lower rates? Because you and I have said previously, there's still an opportunity.
Oh yeah, there are lots of people using Mozo to research the home loan rates, and it's really interesting. We're having a look at some Google research last week. So looking at what search terms people were using. So as well as things like home loans and home loan interest rates and things like that, one of the top terms was financial stress. It was the only term that wasn't directly related to researching home loan options. So obviously there are a lot of people out there who are concerned about their situation and about what they can do about it.
Well, it's certainly getting, crunch time for some people. I was talking to a debt counsellor yesterday who was saying that they literally are inundated with people reaching for help. And he said, what's interesting is we always get requests from, those in long-term financial difficulty. But he's getting a whole new class of people now. These are people with relatively larger mortgages, relatively better incomes, but they're now beginning to find that they just can't square the circle and don't really know where to start. So it is unfortunately, I think, a sort of a leading indicator of probably of a trend we're going to see.
Yeah, that's a really great reflection of just how far rates have risen over such a short period. People who just have not had time to adjust and to figure out how they do accommodate these changed circumstances. There are always choices that we can make about cutting back on some discretionary items and some not so discretionary items if we need to. But yeah, just having to do so much of it in such a short period has been a real shock to people and their household budgets.
And of course, just before Christmas as well. So for some people, I think this Christmas is going to be either the final splurge before they're really tightened down next year, or if they're actually in a worse position, they may actually be dialing back their Christmas spending. So it'll be interesting to see what the end result of Christmas will be. I suspect, though, what we will see is a rise in personal debt, particularly perhaps credit card debt, because we're starting to see some changes there now, aren't we?
Yeah, we are. So, it's fairly typical for credit card providers to launch 0% purchase rate offers on some of their cards to attract new customers to take out cards. This year, we've seen a lot of providers doing that. It's become very common for those offers to be around, probably a bit more than in previous years. But also, credit card interest rates are starting to push up, particularly the low rate cards. We're seeing quite a few smaller lenders who, very much pride themselves on being able to offer a lower rate credit card, having to push those rates a bit higher. The one interesting point that bucked that trend last month was NAB actually cut the rate on its low rate card by 50 basis points to now be at 12.49. So for a low rate card, it's not terribly low. There are plenty of cards below that. But yeah, interesting to see one of the big banks deciding to take on the smaller players by sharpening its offer.
Never heard that of credit card rates drop. But what about term deposits and savings rates? Because they are actually, better than they've been for, as long as I can remember, frankly.
Yeah, savings rates that are above the 4% are becoming much more common now. There are still plenty of accounts that are paying, in the 3% range, but 4% rates are not terribly hard to find now. So, it's great news for savers. With term deposits, there are some signals starting to come through that we may have hit the peak for term deposit rates. The RBA signalling that there are more rate rises to come may change that. So Macquarie has been offering some really sharp rates over the last 6 months or so in particular on their term deposits. But over the last month, they increased some of their shorter term rates, but actually cut their 1 to 5 year rates by 15 to 20 basis points. So, we are, and a couple of providers have done that, where those longer term rates are starting to be pulled back in a little bit, but the shorter term rates still going higher. So, that says to me that the banks have a view that they can afford to compete for those shorter term rates, but the longer term rates they're less certain about. So, yeah, I think, they may have peaked for now.
Well, I'll tell you a little personal story. I went for a 4.95% 5-year term deposit when they were offering them, thinking, gee, that's a really good long-term rate. So I've taken a bet on where I think rates are going.
Look, I think that is a great call. AMP doesn't have the 4.95 available anymore, but Judo Bank does. So, if there's anyone listening to this who is after a long-term fixed rate, that might be a good option to consider.
And it just gives you a bit of a sense of where the benchmark is, right? There are still people, as you say, sitting on 2 and 3%, but you can do quite a lot better. But we'll see. Ask me in 5 years whether it was a good bet or not. But I'm of the view that that's not a bad rate, so we'll see.
I think that's a pretty good rate too. But look, even for 2 years, you can get 4.55%.
Yep.
So, if you're prepared to not go quite that high and finish your deposit earlier, there are some decent options around for shorter terms.
So, Peter, as we sort of come to the end of the conversation, I guess the key question for me is, what should households be thinking about in the current environment, which is a much higher rate environment that they've been used to, with considerable levels of uncertainty, with wages growth still pretty anemic, and inflation running hard? What is the checklist that people should be going through?
Oh, every financial product that you have you should check and see what rate you're paying and check and see what rates are available and consider moving them. It's takes a little effort, but it is worth it. And if you do that across all of your products, so your credit cards, personal loans, if you have one, definitely your home loan, but also deposit accounts, check and see how competitive the rate that you're on is, because it can all add up. And when you're looking at, price increases across the whole economy, wherever you can make a saving, it will help out in the end. And that might mean that you don't have to make a cut somewhere else that you'd rather not. So if you want to keep that Netflix subscription, or keep the kids in a school that charges higher fees, just changing your finances is something that everyone can do, and get some great savings.
And I find that in my surveys, a lot of people still don't know what rates they're actually on. So step one, find out what rates you currently are paying on your credit card and on your mortgage, and if you've got savings on the savings too, and then check to see whether there are ones that are available, and if they are, then it's perhaps worth switching. Of course, if it's a fixed rate, then there's some issues about it, long-term fixed rate, but nevertheless, my view is that this is a relatively painless way of, frankly, managing your finances better, and therefore not having to make some of the tough decisions you might otherwise have to make.
Yeah, and particularly with mortgages, don't just look at the headline rate that your lender is advertising at the moment. Make sure that you check the rate that your loan is actually on, because it may not be the rate that they're advertising. And if you find that you're overpaying with your existing lender and they have sharper deals available, give them a call, tell them you're thinking about moving, and see what they can do for you as far as getting you a discount on that rate.
That's great advice there, because that's often the easiest and most effective way of getting a significant saving. And I can tell you that most banks are very willing to, quote, negotiate, unquote, right, to maintain a relationship at the moment, because, well, there isn't a lot of new growth of new lending. You look at these statistics, so therefore you've got more market power than you have. And last question today. Next year, what's your sense? Do you think we will see higher rates, or do you think we have hit the heat peak?
Oh, look, it's hard to see how there won't be at least one more rate increase next year. With inflation climbing and wages climbing, unemployment remaining low, I think it'll give the RBA the reasons that it needs to go ahead with at least one more, possibly two or three.
Well, Peter, thank you very much for your conversation today, and indeed through this year. Wish you the best over Christmas, New Year, and we'll pick up the baton when the RBA meets again in February. So look forward to that conversation.
Thanks, Martin. Look forward to that too.
Thanks. Take care. Bye-bye.